Welcome back, everyone in YouTube land, to episode number 24. Can a nation monetize national debt without consequence? The surprising answer, based on recent history, is yes. So let's get right to it. Let's look at Japan. Japan ran up national debt about 223% of GDP. They have had very little inflation in Japan for the last 20 years, bumping around zero. And in an effort to cause some inflation in Japan and keep the economy going, the Bank of Japan has purchased back about 43% of their outstanding national debt. The government of Japan owns its own debt, so to speak, and inflation has been flat, and this has all been accomplished until very recently. They had 157 job openings for every job hunter. So they had near deflation despite labor scarcity in Japan, running large national deficits and buying back huge amounts of their large amount of outstanding national debt. Example number 2, of course, is Switzerland, little country, 8 million people. But the Bank of Switzerland recently printed up, digitized, about $800 billion, Swiss francs, and purchased bonds on global asset markets in an effort to keep the value of the Swiss franc down. Swiss manufacturers and tourism were just getting killed by an appreciating Swiss franc. So they never had much national debt in Switzerland, about 33% of GDP, and they now own about 3 times that in foreign bonds. They're going to move a little bit to deflation this year, and they've had very minor inflation in recent years. So there's another example of a central bank that is simply printed up huge amounts of a currency and purchased assets without any inflation in the domestic economy. In fact, deflation now in Switzerland. And of course, we have the United States. The Federal Reserve Board now has a balance sheet of about $7 billion, U.S. economy of about $20 billion. Inflation outlook for the next 10 years, if you believe the Cleveland branch of the Federal Reserve, under 1%. So we have 3 examples of nations that have monetized national debt without consequence to inflation or domestic growth. Now, this is heresy in orthodox or conventional macroeconomic circles, but it certainly raises a question if this is doable, and it certainly looks like it's doable. Why should not the United States authorize or compel or otherwise suggest that the Federal Reserve keep building up a balance sheet of U.S. government bonds? And then in that case, the federal government would owe money to itself, and the burden on taxpayers would be much reduced. Now, the critics of such a policy would tell you, well, that'll lead to inflation. But the examples of Switzerland, Japan, and the United States suggest much the opposite. And there's even a case made in some circles that when a country conducts some quantitative easing, it has eliminated that portion of the national debt, meaning that the remaining portion of the national debt is much more secure in the minds of investors, and they will be willing to invest at lower interest in the remaining national debt. So let's take a look at inflation, even given if the U.S. Federal Reserve continues to add to its balance sheet. Will we see asset inflation? You sometimes see that in the financial media, that the Federal Reserve is underpinning asset values, and there may be some truth in that. But will it lead to asset inflation? Well, take a look. Global asset markets come to about 400 trillion. That's property, bonds, and equities. not counting in some other assets like commercial bank loans and untitled property, which is all over the world, and perhaps art and a few other categories. So 400 trillion in global asset markets, and the US Federal Reserve has a balance sheet of 7 trillion. That's more than a drop in the bucket, but it's more like a couple tablespoons in a bucket. And I just don't see how that small Federal Reserve balance sheet can affect global asset values. We have globalized capital markets, money is a fungible commodity. If the Federal Reserve buys Treasury and lowers the yield on Treasuries, some investors will switch out of Treasuries and move into something else, another category. Maybe they'll move into stocks. But very small amount of influence Federal Reserve has. Okay, so that's asset inflation. What about the consumer price inflation? Will it lead to demand pull consumer price inflation? Again, I think the answer is no, because the world is glutted not only with capital, but with industrial capacity. Something like 30%, the world's automakers could easily produce 30% more cars. Smartphones are abundant. Food is abundant. Even oil. Oil producers, as you know, through OPEC, OPEC Plus, are constantly fighting a battle to keep production down, not up. So I don't think we'll see any demand pull inflation. The last category, cost push inflation, is a little interesting because I think you might get some cost push inflation in U.S. property markets because of the ubiquitousness of property zoning. Essentially, we have criminalized new housing production in large parts of the U.S., the entire West Coast, New York, Boston. And when you have a good economy, people are bidding on these scarce properties, and that does lead to a cost push inflation. If a guy has to rent an apartment for $1,000 a month, can he be a waiter? Well, he's going to want $12, $14 an hour to be a waiter. So you get some cost push inflation from property zoning. U.S. macroeconomists, if they wanted to be of service, would probably pay a lot more attention to cost push inflation and property zoning than they do to the Federal Reserve possibly causing inflation in future years. So that's your tinfoil hat economist, and I am departing you now at the speed of light. I look forward to seeing all of you again in episode number 25. Tally ho.